Hey everybody, it's Dan Rooker here with Lauryn Williams. We're here to break down today in the Student Loan Platter Podcast episode disability and death for federal loans and private loans and everything in between. Lauryn, how are you doing today?
I am doing wonderful. I am so excited to be podcasting with you. It's been a while since we've been together.
Yes, it is. I mean, one that stands out to me was about a year ago. We did a podcast in the month of May. I think we've done some since then, but May was a special time a year ago for
And
me.
and here we are in May again. Well, right on the brink of May. We might be listening to this in June. Hey, never
Yeah.
fear. That's what podcasting is. We record in advance sometimes. So I'm really excited to talk about this topic with you today, though. I think you had some interesting things come up with disability and death, and we're kind of going to walk through what are the difference between disability and death and why it's important when you're thinking federal loans versus private loans. But let's kick it off by just talking about like what is disability insurance, so that people have an understanding of what that, why would it be important as it relates to student loans at all?
Yeah, I think disability insurance isn't something that a lot of people start to think about independently until they have someone else in their family that is wholly dependent on them, and they want to protect their income. And professionals out there in healthcare, they get this insurance conversation earlier, maybe even before they need it. But it's early on for them, and non people not in healthcare don't necessarily see this. If you're going to get your MBA, a disability insurance person is probably not waiting outside of class trying to tell you about this policy you need to get. But it is an important one. It happens to be one of the more expensive insurances out there. It's not like your auto policy or term life insurance policy. I think that uh, how I frame it to both just people in everyday conversation, to clients, to borrowers, if they ask about it in our student loan consult, is that it protects your income, and that you're a lot more likely to become disabled between now and age 65 than you are to die.
Yeah, the stat that I've seen is you're 3 times more likely to become disabled than to kick the bucket, at our age group as, the millennials, even the Gen Xers out there. I know we have all people of different age range listening, but it is something that happens way more frequently than you would expect. And, when you're young and feeling good, you're like, disability? What? Like, I'm not planning on like having any accidents or anything happening, but you absolutely don't want to not be prepared for this, because it's nothing's worse than I'm not actually able to work. I'm not actually able to earn an income. Some sort of health event has come up in my life, and I still have my family to take care of. I still got to keep a roof over my head, and that's where we see, bankruptcy and all sorts of things come. As a matter of fact, medical bankruptcy is the number one cause of bankruptcy in the United States, and you have to throw disability into the mix when you're thinking about that.
Yeah, and I think that with disability insurance, if you're a single person and employed by a large company, there's a good chance you have disability insurance through work. It's a group benefit, and the cost of it is usually covered by your employer. But the cost of it it's expensive. It's not cheap. So you, you probably already have it. If you're self-employed, or you're an owner of a small practice, or you're a small business owner of something, there's a good chance you don't have it in already. And if you are shopping around for you and your employees, say 10 of you, it's an expense, a line item that will show up, and you'll be blown away by how expensive it is.
But it's not one that you want to skip, to that point. Like you said, you don't want to end up in a situation where you are disabled and you're unable to take advantage of the disability insurance. And so one other thing I'll put on your radar to be thinking about as it pertains to disability insurance is a lot of time employers will cover something like 60% of your income up to a certain number. So if you make $10,000 a month, 60% of your income is $6,000. That's what you can expect to bring home. So that's the thing you need to be thinking about, is like, from a budgetary standpoint, how am I going to live on 6,000 if I'm used to bringing home 10? Well, I always talk to my client, like, ideally you're saving some of that. And, if you got a 20% savings rate, which I recommend, in like, okay, we're already only spending $8,000 a month maximum. And then there might be some areas that you can cut back. But you absolutely want to be thinking about like, how does this play itself out in real life if I am to become disabled? And like you said, there's a lot of people out there, the doctors, the dentists, higher earners that need to be thinking about like, what if you hit the maximum benefit? So when I say maximum benefit, like the employer might say we cover 60% of your income up to $15,000 or maybe $10,000 to make my example a little bit easier.
Yeah.
So let's say you're earning $30,000 a month. 50% of that is $15,000. So you're at $15,000 of just 50% of your income. You're not going to get 60% of your income because they said we're going to cover your income either at 60% or up to $10,000 a month. This is the key person that's going to need that additional disability insurance outside of work. And you absolutely want to, like I said, be taking advantage of doing this thing and spending the money. Otherwise, you end up with the 10K when your family's used to living off of 30K, and you're probably going to have some problems paying the bills.
Yeah. Yeah. And if you're making 30,000 a month, don't discount the tax bill. I mean, so you're used to seeing what you see come in through your checking account. And in that situation, the cap was 10,000. You thought you get 60% of 30,000. You don't. And if your employer was paying for the premiums in your insurance, as you when you were working for them, then the benefit is taxable and not tax free. So one thing that separates disability insurance from, say, life insurance is whoever is paying the premium, they are getting the tax benefit. Whoever receives the benefit, if you're receiving the benefit for disability insurance, you filed a claim, but you never paid the premiums from your pocket, it came from your employer, then the amount that you receive every month, say 10K in a month in Lauren's example, is not tax free. You actually get, call it 7,000 a month after tax. So if you're earning 30,000 a month, you're used to seeing some number less than that show up in your checking account because you paid taxes. It probably isn't 7,000 a month. It's probably higher. And there's a gap. You need to cover that gap or change your expenses. And I think the latter part is really difficult to do when you've already experienced a hardship.
100%. So why are we even talking about this? Like why do we pick federal loans and private loans and death and disability as a topic? Like we're diving into disability insurance. Like how is this relevant to a student loan borrower, Dan?
Right, right. Yeah. So if you have student loans, your loans, if they're federal, are just fine as they are if you experience a total and permanent disability. They're not just fine as they are if you experience a partial disability. So your disability insurance policy, whether it's funded through work or you've purchased it on your own, probably pays out if you're partially disabled. Uh, but if you're partially disabled, you're probably earning less than you would have been, and that might put a strain on your ability to make your student loan payments on an income-driven plan, even. Uh, so if it's a partial disability, you kind of need to just that's not something that the disability provisions in federal loans are going to cover. But if it's a full disability, total and permanent disability, if you have federal loans, then you can apply to have your federal loans discharged. That is, they're gone, and they're gone tax free.
Ooh, so this is a good topic. Let's dive a little bit more into this then. Disability related to federal loans. So you said you could have a total discharge. So I know it's called TPD discharge just because I'm a
That's
consultant
our
and student loan
term.
planner and we're smart. um, but explain a little bit about like how discharge works if you become fully disabled. Like what is this,
Yeah,
process like? Has it been like traditionally really hard or like
yeah,
with federal student loans, I feel like nothing is easy.
yeah, yeah. I think that TPD discharge was overhauled during the pandemic, and it's supposedly a lot easier than it used to be. There's different, just a more streamlined process. So right now, as we know it, you go to studentaid.gov, you go to the search bar, you type in TPD, and it should be the first hit, total permanent disability discharge. And when you apply, what you are applying with is a note, probably a letter, a correspondence from what are the three places?
The Department of Veteran Affairs, the Social Security Administration, or a physician. Those are three different sources of documentation that you can use to prove that you are fully disabled.
Yep. And the details for the documentation you need from either of those, any one of those three places, the VA, SSA, or a physician note, uh, are on that page. Are on that page, and that's so. Go to student.gov, search TPD, look through the requirements. This is something you might do if you experience this and you need to file for it. Otherwise, I think the place to start is go to the homepage, search TPD, and
Uh,
from there. Oh,
no, go ahead.
well, so I think that once you apply, it's like if you've applied for PSLF to get an update, if you've applied to consolidate your loans, if you've hired us and we've walked you through that process, you know that they work on government time. It's going to take some time. It's not immediate. And part of the problem with the TPD discharge process that was overhauled during the pandemic was the amount of time it was taking. There were a lot of people that had their applications in a queue just sitting there for months and months, not hearing anything, no communication. And in the meantime, it's not like life just went on pause or expenses went on pause.
Yeah, which was why the COVID forbearance was so great, because people were able to take advantage of like not having to pay their loans. But in the case of TPD in general, you won't have any payments on your loans while your discharge application is being reviewed. But there's also the kind of risk, like what happens at the end of the review if it doesn't go quite as planned. I guess you would pick up where you left off, but you do get that like short term, like, okay, we don't have to do anything right now. So that relief happens until you know for sure what happens. But one thing that's important too to know is that there's this 3-year monitoring period after. So like, let's say they do, you sit, you get the review, they say congratulations, your loans have been fully discharged. It's not just like, okay, walk away and nothing ever happens again. There's a 3-year monitoring period where there's a criteria that you have to meet from an income standpoint, that you want to make sure that you don't actually have your discharge taken away or retroactively revoked. So be mindful that it's not just like discharge and run off. Your income will be monitored over that period of time, so that you can actually make sure that you meet the requirements for disability discharge.
And I think that if you're going to apply for this, what you've got in hand already from the Department of Veteran Affairs or the Social Security Administration or a physician is something that says you're 100% disabled. If your Department of Veteran Affairs note says that you're 70% disabled or 50% disabled, which is not uncommon, uh, that doesn't qualify for total and permanent disability discharge. If it does say 100%, uh, then you probably have a follow-up period from the Department of Veteran Affairs to check in and see if you continue to be 100% disabled. And as they check in with you on their side for their program, the TPD discharge program through the Department of Education is going to monitor you, like Lauren said, over 3 years. So the topic for today's conversation came up from a consult I did recently, and it was a borrower who booked the call because they had refinanced their loans way in the past. So the loans have been refinanced; they were no longer federal, and they wanted to know what their disability, if there were any disability discharge options available to them. And I think what we did was we spent most of the call trying to tackle that topic. I mean, if they're not federal loans, they're private loans, and if they're private loans, how does that even work? And it wasn't really for them; it was for their parent. So I think from the top, if you have if you're listening to this podcast, you're listening for a reason, and it may not be for you specifically. Maybe it's for siblings or a parent or a spouse, and you knowing about total permanent disability discharge for federal loans, and then we're going to talk about private loans here in a second, is just something that you can be on the lookout for them.
100%. Sharing is caring. You hear me say it on pretty much every episode. What I really love about this work is that the information that we get sometimes comes from borrowers who have had different experiences. I just did one talking about like the refund process because a borrower like wanted to share that story, but you may not everything that you hear today may not be relevant to you, but it may be relevant to someone in your life. And so don't be afraid to share this information with someone, or it may not be relevant right now, but it may become relevant later. And that's why, gathering as much knowledge as possible is important.
Yeah, and on the federal loan side, if you have Parent Plus loans or a parent of yours has Parent Plus loans, historically there's been a lot of uh, pressure to refinance those loans, to move into the private space because they're at high interest rates. They're higher than all the others. Like you got Parent Plus loans this school year, they're going to be at 7.54%. They come with a 4+% origination fee, and continued interest after graduation is a lot of pressure when maybe a private lender of the future is offering a lower interest rate. Well, when you do that, if you do that move, just be mindful of what that means from a risk standpoint. Because if they stay as federal loans, doesn't matter if they're Parent Plus or Graduate Plus or direct staffers, subsidized or unsubsidized, they're all federal loans. Those loans are eligible for total and permanent disability discharge if they stay as federal loans.
Okay, so let's talk a little bit about private loans and how that plays itself out as it pertains to disability discharge. So I think you have an example for us, Dan?
Yeah, so I was looking up, it's different for every lender out there. If you go onto our page on studentloanplanner.com and are looking to shop to refinance, you'll see a list of lenders that are on our page there. And one of them that I've noticed has continued to show up there is Splash Financial. So I just went and looked up Splash Financial, what are their disability provisions? And their website says forbearance and death or disability discharge may be available depending on the financing partner, but it is not guaranteed. Check your loan agreement to be certain. So, how would you interpret that?
Yeah, the same way I interpret everything as it relates to private loans is like you have to understand what the specifics are related to your specific loan. So look at the promissory note, understand it, ask these questions in advance. A lot of times people come to us and they're, thinking about refinancing and all they're focused on is the interest rate. But we need to do as much financial planning as we can for what we can't see coming down the road. And this is one of those considerations. And the more that borrowers start asking about it, you call and you sound like an educated borrower. You're saying like, hey, I love the interest rate, but also is forbearance available to me? How much forbearance is available to me? Are you charging interest during the time that I'm in forbearance? What happens if I kick the bucket? Can I just provide the death certificate and this gets discharged, or is it going to be a part of my estate? And you starting to ask those questions of borrowers and of lenders, and more and more people asking those questions, they're gonna be like, hey, we can stand out to you all as a great lender if we provide this benefit or that benefit, and one of those benefits can be disability discharge. But the short answer is like it's going to depend on your lender, but this is absolutely a question worth asking and something worth figuring out before you refinance.
Yeah, yeah, and it's kind of like it's sort of like, I don't want to get political, but it's sort of like voting. It may feel like your question isn't going to make a large impact to the lender, but these are smaller than our voting system. They are private companies. They will react to the questions they're getting from the people that are making them profits long term. So if you're one of many people, if you ask the questions about forbearance or disability, and someone else asks the questions about forbearance or disability, it's going to add up. It's going to draw attention, and maybe that lender will start to promote it so that it's easier to see, oh, this is how their contract is written up for the people down the road. Sharing is caring. So share by asking good questions. And
Yes. Little people can make big changes, and we are the little people that can make those big changes. You got to think about the big picture though in order to be able to make those big changes. So imagine this playing itself out. You ask the question, the person on the phone doesn't know the answer to the question, so what do? They go to the next staff meeting and they ask the question of the group, and everybody's looking around a little bit crazy, and maybe the marketing person's in the room and they're like, nobody knows the answer to this, but also like, what if we gave everybody disability discharge. Like, how much would that cost us? And then there's, the stats person in the room, and they're running the numbers to figure it out. And before you know it, like you said, this company XYZ is now marketing, hey, and your loans are discharged and disability. And you're like, oh, let me go over here because this is a thing. So
Yeah.
don't underestimate how you putting that thing in motion can actually make a really big difference for not just you, but for a lot of people.
Let's play this out. If you were, let's say your loans are already at a lender and you've checked the loan contract and they don't cover it. If that's you, then maybe the next solve is, well, do I have coverage out there to cover it? And so if you're the dentist or the physician who bought disability insurance on top of your group coverage because you needed it, there was a gap, you might have a rider on that policy that pays a certain amount per month. I think what we've seen as common is $2,500 a month as a student loan payment rider. It's an extra, it's an add-on on the policy. And if your loans are going to stay federal long term, you don't need that add-on. That's extra cost you can cut off. But if you have private loans or you're thinking, I want to leave the door open to refinancing, then having that rider added on to the policy that you purchase can be a good backup in the situation where your lender doesn't provide discharge.
Yeah, so much of financial planning is looking at what you can't see happening and trying to make a plan for that. And you'll be so happy with yourself if you spent that extra money and you have this coming down the road, because you can't just like let your finances go to crap and file for bankruptcy. Like, student loans aren't discharged in bankruptcy. So you absolutely want to be forward thinking as it pertains to, how this might, affect you or, the long-term impact of something like this happening. So
Yeah.
let's move on to talking a little bit about death. We talked a lot about so exciting, this podcast. Like none of the morbid topics at all, right?
None.
But they're really, really important because, like you said, you're going to work every day, you're building wealth, you're building a legacy. So many people are talking about generational wealth now, closing racial wealth gaps. There's so many different topics. Like, it all starts with like education and knowledge around what you can't see coming and being prepared for those things. So we are all going to kick the bucket. I hate to be the one to tell you at some point or another, some of us sooner rather than later. And we need to know what's going to happen with our student loans and death. So Dan,
Yeah.
what happens?
Well, if you have federal loans, it's super straightforward. They're gone. They don't become your spouse's burden, your sibling's burden, your parents' burden if they're in your name. And so, to be clear, if you're a parent with Parent Plus loans, they are in your name, not your kid's name. And if you are a graduate student with loans in your name, they're in your name, not your spouse's name.
I think that can be really freeing, though, for a lot of people, because you wouldn't believe the number of times that people have come and they're like, we're not getting married because this person has this student loan debt and I don't want any parts to do it. We handle our finances separately because they have so much debt. So it's like, I love you, but also I don't love your debt. And they're like, oh my goodness, this is like completely overwhelming. And so they're completely relieved to hear like, oh, I am not on the hook for this debt either way. So it doesn't affect whether or not you decide to marry your finances. It doesn't affect, whether or not you all decide to get married, like all those things you were saying. Like, it is the person whose debt it dies with them.
Mm-hmm. Yeah, and what you do, so if this is you, you won't be around to have to go through these steps. But if you want to educate the person that is going to have to go through these steps to discharge your loans when you're gone, step one is probably something they'll already have, a death certificate. Usually, when this happens, your family or your descendants, whoever's taking care of your estate, will order death certificates through the funeral director, and they'll have a number of copies. Well, they'll need to provide one of those copies to the federal loan servicer that you have, and the federal loan servicers, there's a handful of them out there. The one that comes to mind for me is Nelnet. Nelnet's a big loan servicer, so we'll just use them as an example. There's others. The person handling the death certificate would call Nelnet and identify themselves, identify you, notify Nelnet that you have passed, and they'll be directed on where to send or how to send the death certificate.
Easy peasy, not too much to go into that. And so to circle back to the Parent Plus loans, if the parent passes away, the loans will be discharged, and if the student passes away, the loans could be discharged. So two people are kind of mixed in here with the loans and as it pertains to Parent Plus loans, and these loans can disappear for in the circumstance that either of them pass away. So that's a pretty cool feature.
That is a cool feature, and I have been, and I missed that from earlier. But if I have been asked on consults, what happens if we consolidate the loans, and this is usually on a call where there's a couple, or it's a borrower and their parent, and so a parent can consolidate the loans, but the loans stay in the parent's name. Consolidate means stay in the federal system. A parent can also refinance the loans, and the loans could either stay in their name or they could go into the child's name. And if they go into the child's name, then the loan provisions there at death are subject to the contract, just like disability before, that they've signed with the private lender. If the loans are refinanced into the parent's name, it's the same answer. The loans are subject, now that they're private, they're now subject to the contract that they've signed with the private lender. So check your loan provisions for private loans. But in the federal system, you cannot move loans from the name of the parent into the name of the child. Fortunately, like Lauren just mentioned, if either child or parent pass away, they're forgiven.
Everybody's off the hook. Whoop, whoop, whoop. So yeah, let's talk a little bit more about the private piece of the puzzle because, if they just disappear when they're federal, that means they're not part of your estate. But when they're private, pretty much they're always going to be a part of your estate because there's no administrative discharge for private student loans. The debt is going to be handled the same way that other debts are handled. So if you've got credit card debt, if you've got a mortgage, all of those things are going to have to pass through your estate. They're going to pass through what we call probate, and your debts will try to be settled as per what you have. So, things like your car will be sold and your bank accounts, emptied in order to be able for the people who have outstanding debt related or the companies that have outstanding debt related to things that you have borrowed, they will try to pay those debts off via the estate. And so that diminishes what you have available to leave behind to, your loved ones. Now, to be clear, like there's things like IRAs and, retirement accounts and things that will have beneficiaries. That's not where they're going to take the money from. Those things will pass to the person that is the beneficiary. And we're kind of heading already into the estate planning conversation, which is our next topic. But the thing to be mindful of is like federal loans pass away with you. Private loans will be a part of your estate and will be handled, like I said, like any other debt. So you want to be mindful of the it depends part of it that Dan is mentioning. And you want to know what your promissory note says. And you also want to call and ask those questions, just like we were saying earlier. What happens if I kick the bucket? Because it might be that cause for change if they don't have nice provisions related to death.
Yeah, and just like we talked about with disability, if your contract says there is no death discharge with a private loan, then there's a way to protect around that. You can, and maybe you've already purchased enough term life insurance to cover that. Sometimes people, when they buy term life insurance, they go a little extra above and beyond just to be sure. And maybe some of that little extra above and beyond includes $100,000 of student loans. If it's not enough, then you can buy more term life insurance to cover it very cheaply.
Yes, I love that you brought that up, Dan, because we talked a lot about disability insurance, but life insurance is a key piece of this puzzle as we're planning for death, disability, estate planning, all of that as it pertains to student loans. You definitely don't want this to be something that, like you said, is diminishing the wealth that you want to leave behind. You want to make sure that your family has everything that it needs in order to be able to carry on without you if you're not around. So it's a great hack to pick up some term life insurance that will cover your student loan balance, especially if it's a bigger one.
Yes, especially if it's a bigger one. But and remember, just like with disability, if it's federal loans, you don't need that extra term life insurance for the loans. If you want to keep the door open to, if you think you're going to refinance, I've done a lot of consults where we're on an income-driven plan, but that's a temporary plan. It's just to take advantage of the interest subsidy on this income-driven plan, and we plan to pay this down to zero one day. If you're already shopping for term life insurance because you just bought a house or you just had it, you're expecting a child, you can throw this number into that to plan in advance, like Lauren mentioned earlier about what financial planning is.
100%. And so financial planning is all of the topics that we're talking about. There's lots of different things. We talk about investments and budgeting, debt, estate planning, taxes, insurance, you name it. Like these are all topics within the planning piece of the puzzle. But to kind of wrap out our conversation today, I wanted to talk about estate planning because I do think that is something that people also need to be considering as it pertains to their finances and their student loan strategy. So the first thing I want to say is that estate planning is not just for rich people. People are like, well, I don't have an
Hmm.
estate, Lauren. I got 6 figures of student loan debt. Like, I'm trying to make ends meet. I don't have a job that is earning in the way that I thought I'd be earning. I'm hearing you all as you think through, like, I don't need an estate plan. Do not cut this podcast off because we are not done. Estate planning is for everyone. Um, and so, biggest mistake that you can make is waiting too long to get started as it pertains to estate planning. I'm young, I'm healthy, I don't have kids yet, and on and on and on. People come up with the reasons that they don't need it. If you are a single woman living alone, don't ever want kids, don't want to get married, you still need to get your documents together because there's a lot of things you need to be thinking about. So, what happens if you become incapacitated and someone needs to make decisions on your behalf? What happens if you're on a ventilator and they need to decide like whether or not to pull the plug? There's a lot of different things related to your overall life that need to be considered, but then also your finances. Who's going to get what you have, even if you don't have, that core group of loved ones that people talk about, a spouse or kids or, parents in your life, etc. That money still has to go somewhere, and you don't want it to just go anywhere. You want it to go as per your wishes.
Hmm. And I think it's like you just pointed out. I think with your example, Lauren, it's not just a when I die plan. It's a if I'm still alive but I can't make decisions for myself plan. And we opened the conversation about disability and how it's much more likely, 3 times more likely before the age of 65 than dying.
100%. And so, what should you be considering? Why do you need these documents above and beyond what I just mentioned? Are digital assets like, you see those RIP 1,000 comments under someone's Instagram post, the last Instagram post they had. You see other people posting about the person who passed away. Like, what do you want to happen via social media when you're gone? Do you want them to shut your page down? What if you had like scheduled posts to go out? This is what has come up a bit. You've kicked the bucket, and for 2 or 3 months later, like you're still marketing to people, or putting out posts that you had planned to do previously. Like there's some things you need to consider. Like who's going to have the passwords to things to get in to cut it off and stop that, or just to get into your documents in general. Who's going to be able to log into your bank accounts or log into other pertinent accounts? Where's that master password? Also, guardianship. This is one that comes up quite a bit. The majority, actually all of my clients have come to me without estate planning documents in place, and all of the ones with children have not even thought about the guardianship piece of the puzzle. And it's a big danger. You care so much for your children. What happens if you go out on date night and you don't come home? You left them with a babysitter that was going to be paid for 2 hours. That's like, 18 years old and doesn't plan on keeping your kids for the next 4 or 5 days. Who's the short-term guardian that's going to jump into action while things get figured out? And then above and beyond that, who's the long-term guardian? So maybe you have, your sister that lives across country that is the person that you want to be able to take care of your kids forever. But over the next couple weeks or the next couple days until your sister can fly in and, arrangements can be made, et cetera, et cetera, someone's going to need to look after your children. So you need to have those conversations with people about like, hey, if something happens to me, can you do this? Are you willing to do this? But then above and beyond that, you need to have the documentation in place that says, hey, Jane gets my kids for the short term and Billy gets my kids for the long term.
Hmm.
And you also want to be thinking about like, how are they going to take care of your children, because they probably got their own kids and their own life and their own expenses. So that's where the life insurance comes back into play again, is making sure that there's income to replace your income should you not be around.
Oh, I love that, Lauren. This is so important, and it's just bringing up all these ideas. I know that we've gone over some notes and stuff, but let's so like digital assets. That made me think about how like in our world we have, and in just small business, you have business continuity plans,
Mm-hmm.
and with larger companies too. How does the company go on without you, or how does it gracefully get shut down? And if you scheduled posts, I can't imagine. I mean, so having someone, creating an emergency action plan for your digital assets, giving someone or letting someone know how they would access these things and shut things down, or let those. post go out, guardianship for your children. These are really important topics. What else do you? What else is there to unpack?
So another one is, if you guys can't tell, I got really passionate. Like I loved, like I'm probably a little bit weird in that regard, talking about death, but to me, it's just such a huge planning opportunity. When people, like I said, are so passionate, like there's so many narratives now about like creating wealth and fire and all these different things, but like it can all be for naught if you're not prepared in this way. And this is like the ultimate, to me, level up of your finances. So. Other things that you should be thinking about, like rental property. So that's something that a lot of people that are listeners here, like I said, they listen to Fire podcast, they listen to the Bigger Pockets podcast. It's all about rental property. But they get rental property and they get it all over the country. Every state has different laws. So you live in Texas and you've got rental property in Florida and Massachusetts and God knows where else. You need a plan for that rental property. And you probably need a trust for your rental property. That is a really big deal, because what's going to happen? Who's going to continue to manage it when it's gone? But also, like you said, your estate planning documents are going to be via the state that you're in. So you're going to need multi-state estate planning documents if you have rental property in different states. The other thing that comes to mind for me is having conversations with loved ones. So those tough conversations, like you said, if you're 30-something right now, you're like, I'm healthy, I'm happy, I'm not going to kick the bucket. One, like I said, it could happen to any of us. But two, what's more likely for the 75 million millennials that are out there? It's that our parents that are baby boomers are now retiring. They're in poor health. They're closer to kicking the bucket than us. If they don't have estate planning documents in place, who carries the burden when they pass away? That's us. We don't know what to do. We don't know where to find their information. They don't have any information. They didn't save anything for getting them buried. You don't know if they want to be cremated or if they wanted to be buried. Who gets what? If you got multiple siblings, it becomes a whole hullabaloo on top of the fact that you're grieving someone that you really, really cared about. And so what do they do when you start to ask them? I know exactly what my mom did. She was like, oh, let's talk about this later. Let's not talk about this. And I had to really Mom, this is for me and you. You say you love me, then I know you don't want to talk about death, but how is it going to make me feel if I don't know what to do when you kick the bucket? I'm already going to be sad. The last thing I want to do is also try to figure out whether or not you had any life insurance, whether or not you wanted me to get the cats or my sister to get the pots and pans. Like, that's something that we actually have had a conversation about. And so you want to prioritize getting your loved ones to have these tough conversations. And, if you're married, you want to prioritize having these tough conversations with your spouse, because the last thing I want is for, my spouse to think that he knew what I wanted when actually I wanted this over here. Like, I want to have a big party. I want it to be rocking. I don't want people crying over me. So I chose to be cremated. Like, that's my thing. And my friend was like, I can't believe that you're going to, be cremated. We all want to be able to see you. And I'm like, there's no guarantees. Like, you don't know how I'm going to die, first of all. So it might be a closed casket situation. But I just don't want people seeing like a pasty Lauryn in a casket as their last thing. Like, pull up a video, pull up an Instagram post of when I'm live and full of life. And let's have a good time. And, let's run a slideshow like that. So be thinking about how you're going to have these conversations and what you actually want for your life. One other thing I'll say is domestic and partnerships, common law marriages, what kind of state you live in, the LGBTQ community, same-sex marriages, or, same-sex with kids. Like, who had the child? Is there proper documents in place to say that, like, I'm also the legal guardian of this child? I am the one that's going to be the caretaker, not the sperm donor, the egg donor, should something happen. You kind of make those assumptions on the front end, but you absolutely want to have paperwork that says, like, no, this is the parent. This is the other parent if I'm not around, regardless of what genetics say. This is the person that's supposed to be caring for that child.
Absolutely. Yeah, these are great topics, Lauryn. There's so much to it too. I mean, this is just what you word vomited about it, but and you've had that conversation so many times. I'm sure you covered most of it too. I think that there are solutions out there. There are economic solutions out there. There are also more individualized solutions out there. Just take just like yourself, your situation, and if it's your first time, you could go to a place like trustandwill.com. If you've done this before, this isn't your first time, or your situation is more complicated than uh, what you might start out at, then maybe work with someone local, or to update if you've gotten your documents done in the past through a state agency because you worked there and it's $400 to do it. Start there because maybe you want to update the documents and they'll do it for you for a good price. But don't just chase price, chase quality,
Mm-hmm.
and know your situation. A lot of these things, and if you're not in that situation, this conversation is too soon, or you think it's too soon. We started out by saying it's not only for rich people. There is a lot that you can do to surround. I mean, creating the legal documents is one thing, but the legal documents don't take care of it. There's a lot that you can do around the edges to fill it in, and there's a lot you have to do too. I mean,
Mm-hmm.
an estate attorney is not going to sit there and make a plan for your Airbnb rental property, you know. And as soon as you go, if you were the one that was managing the short-term rental property, not a long-term rental, and you were the one handling all the communication with future bookings, and there's no one in place to do that, your future bookings don't happen. Income doesn't continue to come in. The mortgage doesn't continue to get paid. That is a train wreck waiting to happen.
A whole train wreck, and such a good example because there's so many people out here that are interested in rental property, that have rental property, and like you said, are not taking into consideration like what happens if poop hits the fan. Like you said, someone's standing on the porch in the middle of the night trying to get in, they don't have the code, the place hasn't been cleaned up from the previous person that checked out, and on and on and on and on. um,
Yeah.
it can get real quick. And like you said, if this is something that was meant to be creating wealth or generational wealth for people that are coming behind you, you don't want that ball to be dropped and bad reviews to be had, or or just to be just sitting out there in a balance for a month or two until someone can pick it back up. So
Mm-hmm.
you absolutely want to be thinking about that. And I love what you said about trust and will. It's a great, easy place to get started. Other things that you can do are get beneficiaries on. Make sure that beneficiaries are on everything on your bank account. So they call them usually transfer on death or payable on death. You can put something that is the equivalent of beneficiary. So that, what does that do? You got an emergency fund. Maybe I put Dan as my payable on death. He goes and he gets direct as soon as I pass away access to my bank account. So now he can get me buried. Maybe the life insurance money takes a while to come. You see these GoFundMe all the time for people that are trying to like get money together because someone passed away. It might not be that they're broke. It might not be. It might just be that they don't have. No one has access to their funds to be able
It's
to,
frozen.
to
Yeah.
actually. Yeah.
Yeah.
So, and my last thing that I'll say is like, don't go through all the trouble of getting the estate planning attorney, getting the trust put in place because everybody always wants to go to the next level thing. For me, people want to get the trust even when they don't necessarily need it. Just the way they want to get the LLC and they want to get the S corp even though they make like 20 grand a year. They're like, oh, but I heard you could save money if you do this thing. It's the same thing with the trust. It's like the cool thing to do in the estate planning world. You can go through all the trouble of creating the trust and you don't actually fund the daggone trust. And that is like my all-time pet peeve. And it's something, honestly, I didn't even know. I had my CFP and I still didn't know that. I was doing my own estate planning documents and the estate planner explained it. She's like, okay, so now you got to fund the trust. And I was like, what does that mean? I created it. We signed all the paperwork. Like, what are you talking about? Well, everything now needs to be named in that trust that you created in order for it to be funded. So now my bank account says like Lauryn Williams Trust on it. Everything goes to the Lauryn Williams Trust, and then everything goes out via what I said I wanted the trust to do. So
Mm-hmm.
fund your trust. If you created a trust and you don't know what I'm talking about, you probably didn't fund your trust, and you need to do that.
Yeah. Yep. Do that. And if you're not sure how to do that, that's you hired an estate attorney to create the documents. Ask the estate attorney how to do that. What are the risks of when I go to try to retitle my house? Who do I need to notify before I go and do that? Um, you know, so if you're paying for the advice, ask good questions. That's the best way to make the most of it. And like Lauren said, fund the trust. I think estate planning there's estate planning on paper, and then there's estate planning for life. They're not one and the same. There's a lot of things that you can do, even if you don't go the route of hiring an attorney at first. And just ask yourself, what if? something I wasn't expecting to happen happened. Is everything that I'm doing in my life and the people that I'm supporting or that I'm helping to support, or the income that's coming in, as in this economy that we live in, where there are a lot of self-employed people out there, either full-time or part-time. How do I want that to continue? How do I ensure that it continues? Or how do I gracefully shut it down?
100%. I think we've kind of berated the people enough with all the morbid topics, from disability insurance to what happens if you become disabled with your federal loans, your private loans, what happens if you kick the bucket to your federal and your private loans, and last but not least, we covered estate planning. So you all should be a lot more well versed on what you need to do to plan for catastrophes, and you should absolutely plan for the worst and hope for the best, so that if something comes up, people can keep on plugging along and it's not as painful for them as it could be, because any of these things happening to you are not going to be a fun situation, but they can be. The not fun situation can be exacerbated by not having proper planning in place.
Great. Thank you, Lauren. This has been awesome. I really enjoyed unpacking these topics with you. I'm hoping to get on another podcast with you sooner than next May. And for all of you listening, we've got some great topics coming up this summer. A lot of excitement with or maybe I shouldn't say excitement, but the payment pause. We'll see what happens with that. By the time you listen to this, maybe we'll have more clarity on that too. Keep reading our Thursday emails from Travis. Keep reading the one-off emails that go out as well. And thank you for listening. Thank you for supporting us.
Till next time.